Inflation is constantly monitored and worried about by investors, the Federal Reserve, and companies. Inflation greatly diminishes the purchasing power of each unit of currency by increasing the price of goods and services. Inflationary pressures have a sneaky effect, which includes making input costs rise, consumers buy fewer items, revenues and profits fall, an economy slows for a while until a level of economic equilibrium is reached. The impact of inflation on dividend payout has been a subject of debate in previous studies. Some studies have concluded that inflation has a beneficial influence on dividend payout because of the normal rise in money quantities that results from an increase in inflation, at least in the short run. In today's video, we'll look at how the Federal Reserve plans to salvage inflation's latest surge and what good dividends will see a boost because of this. Don't forget to like this video and hit the subscribe button as well. Inflation has been on the rise, with a 6.8% increase in November compared to the same month last year. This was the most significant year-over-year rise in about 40 years. Thankfully, some dividend stocks may benefit from the Federal Reserve's response to this problem. To assist limit inflation from ballooning out of control, the Federal Reserve said that asset purchases would likely be tapered off by March of next year, which is earlier than it usually is. A majority of Fed committee members expect interest rates to rise by at least 0.75% next year, according to the report. In 2022, this suggests a rate hike of at least 2 to 325 basis points. Financial stocks, particularly those in banking and insurance industries, would benefit from higher interest rates. Higher interest rates would result in higher net interest income, which might stimulate a long-term recovery in this sector of the economy. If you're an investor looking to profit from this opportunity, you should focus on the finance sector's highest quality names. Let's get into our top 3 suggestions. 3. JP Morgan. JP Morgan Chase & Company is not just one of the world's largest banks, but also one of the world's largest corporations, with a market value of $463 billion. Consumers and commercial banking, mortgage financing, credit cards, asset management, and investment banking are just a few of the services offered by this corporation, which has nearly 4,900 locations. In 2020, the corporation generated over $120 billion in revenue. Leadership noted in the most recent results announcement that the net interest income projection for 2021 was around $52.5 billion. The guideline was repeated before the Fed stated that it was considering a policy adjustment for the coming year. In the most recent quarter, net interest income increased by 1% to $13.2 billion, owing in part to slightly higher rates than the previous quarter. When rates are still low, a slight increase in net interest income could portend big increases in this area over the next 2 years. As the Fed continues to tighten its monetary policies, JP Morgan should be one of the first to benefit from rising interest rates. Increased house sales benefited JP Morgan as well. JP Morgan, as a top lender with an average loan size of $1 trillion, has a size and scale unmatched by most competitors, which might help it avoid significant weakening if rising rates do put pressure on loan demand. During the Great Recession, JP Morgan slashed its dividend, but it has since been raised for 11 years in a row, and the stock yields 2.6%. Using our earnings per share projection of $15 for 2021, shares trade at a price-earnings ratio of 10.4. 2. Commerce Bank Shares. Commerce Bank Shares is a bank holding company for Commerce Bank, which offers retail and mortgage banking services. Asset management, corporate, investment, and trust services are also available. The corporation is worth $8.3 billion and generates $1.35 billion in annual revenue. Commerce Bank Shares' growth from interest-related income has been stifled, as it has been for other banks due to interest rates hanging at zero for an extended period of time. Nonetheless, the company has recently seen small gains in this sector. Commerce Bank Shares' net interest income increased about 3% year-over-year in the most recent quarter, thanks to greater earned income on investment securities. Reduced interest earned on loans and securities acquired through resale agreements helped to counteract this. The net yield on earning assets declined 2 basis points to 2.58% as a result. Net interest income was down about 1% on a sequential basis due to decreased average loan levels. However, as the economy recovers from the COVID-19 outbreak, Commerce Bank Shares has seen a surge in commercial and construction loans. If the economic recovery continues, the organization should anticipate an increase in loan demand from these locations. Commerce Bank Shares' net interest income would almost certainly grow faster if interest rates were higher. Rate hikes would almost certainly result in higher mortgage rates, but not to the point where demand would dry up. In truth, home sales are still high as unemployment is at its lowest level in a long time and supply continues to fall short of demand. Commerce Bank shares would be able to achieve greater average yields on its loan portfolio while also benefiting from rising income from investment securities. Commerce Bank shares has one of the market's longest dividend growth streaks at 53 years, making it one of only 35 dividend kings. The stock yields 1.6% and it's worth 15.3 times our projected earnings per share of $4.40 in 2021. 1. Aflac. Aflac, a diverse insurance company that sells accident, cancer, short-term disability, life, dental, and vision insurance, is the first on the list. Japan accounts for somewhat more than two-thirds of revenue, with the United States accounting for the remainder. The almost $38 billion firm generates more than $22 billion in annual revenue. Aflac makes money by underwriting policies and investing in financial assets, just as other insurance businesses. Aflac's net premium income for the most recent quarter was more than $4.3 billion and $13.2 billion for the first 9 months of the year. Aflac's premium is invested in financial assets such as government and corporate bonds. The corporation isn't getting much of a return on its investment because interest rates are so low. Aflac, on the other hand, may begin to experience further profits on investment with each Fed rate hike, resulting in higher profitability. Higher interest rates, on the other hand, are unlikely to have a direct influence on the company's ability to see demand for its underwriting services. This would give Aflac the best of both worlds, as its insurance products would continue to be in demand while rising interest rates would provide the corporation with larger investment profits. Aflac has been in business for over 65 years and has learned how to manage the market no matter what the circumstances are. It's one of the reasons why the company's dividend has increased for nearly 4 decades. Aflac's stock is currently trading at a little over 9 times our year-end earnings per share estimate of $6.10. The stock also pays a 2.9% dividend, which is 3 times the S&P 500 index's average yield. We sincerely believe Aflac, Commerce Bank Share, and J.P. Morgan will benefit significantly from increased interest rates. Each stock has a dividend yield higher than the S&P 500 index average and trades at a low price. These 3 stocks could be appealing to you as an investor that is trying to profit from higher rates. Which of these reliable finance companies would you be willing to invest your money in? Go ahead and let us know in the comments section below. Have you found this video helpful? Then please like our video. Also, don't hesitate to join the money-making community, subscribe to our channel, and hit the notification bell so you are always updated when we upload new content like this one you've just enjoyed. Thanks so much for watching this video. What are you waiting for? Go ahead and check out our other videos on our channel. Bye for now.